For decades, one of the biggest questions in global economics has been this. What is really going on with China's currency? Is it some kind of secret weapon for an unfair advantage? Or is it a necessary tool to keep a massive economy stable? Well, the answer is a fascinating story about China's unique economic model, and believe it or not, how it affects pretty much all of us. So let's get into it. Okay, here's our roadmap. First, we're going to look at how China actually sets the price of its currency. Then, we'll dive right into that huge debate over whether it's undervalued. After that, we'll get to the real root of it all, this idea of a nation of savers. We'll connect that to what's happening with global prices right now. And finally, we'll unpack the really tricky dilemma that policymakers in Beijing are facing today. All right, let's start with the basics. You're probably used to currencies like the US dollar or the euro, right? They float around, their value changing based on the market. Well, the Chinese yuan is a whole different ballgame. Its value isn't just left to chance, it's very carefully managed. And understanding this one core mechanism is really the key to the entire puzzle. So the system China uses is called a managed float. Think of it as a hybrid. It's this middle ground. It's not totally rigid like when China used to have its currency locked to the dollar, but it's definitely not a free-for-all either. The best way to picture it is that the central bank has its hands on the steering wheel. It lets the market push things along, but it's always there making little corrections to guide the currency exactly where it wants it to go. And it's really important to see that this system didn't just pop up out of nowhere. For a long time, it was a hard peg, just locked in place. Then, back in 2005, there was all this global pressure, and Beijing finally introduced the managed float, giving it just a tiny bit of room to move. Over time, that band widened to the 2% we have today. But what's so interesting is that lately, that management has become so tight, it's almost acting like a peg again. Stability is clearly the #1 priority. So how do they do it? Well, the heart of this whole system is something called the daily fix. Every single morning, China's central bank announces an official midpoint for the yuan against the dollar. Now, this number is supposed to be based on two things: where the currency finished trading the day before and how a whole basket of other world currencies has been moving. That number sets the stage for the entire day, and the yuan can only trade 2% above or below that official rate. And that daily fix? Well, that's what leads us right into the middle of the whole controversy. For years, the big accusation has been that China deliberately sets this fix too low, that it's undervaluing its currency on purpose to get an edge in trade. But is it really that simple? The entire debate really boils down to these two perspectives. On one side, you have the argument that a weak yuan is basically just an export subsidy, plain and simple. It's designed to make Chinese products dirt cheap for the rest of the world. But on the other side, the argument is, hold on, the reality is way more complicated, with a whole web of effects that aren't just black and white. So let's look at that first argument. The logic is pretty straightforward. If the yuan is held at an artificially low value, then every single thing China sells is cheaper for anyone buying with dollars or euros. This just pours fuel on their export engine. And at the same time, it makes foreign stuff more expensive for people inside China, so they buy less of it. This dynamic has been blamed for years for causing huge trade deficits and contributing to the loss of manufacturing jobs in other countries. But this is where the story starts to get a lot more complex. First off, those cheaper Chinese goods, they've meant lower prices for consumers in the US and Europe for a long time. But here's the really crucial part. To keep its currency from getting stronger, China has to constantly buy up foreign currency, especially US dollars. And what does it do with all those dollars? It buys US government debt. So, in a weird way, China becomes one of the biggest lenders to the US government, which helps fund American deficits and keeps interest rates lower than they'd otherwise be. This raises a really interesting question, though. If this policy creates so much tension around the world, why do they stick with it? Well, the answer, and this is surprising to a lot of people, has less to do with exports and much more to do with what's happening inside China's own economy. When you dig into this topic, one detail that often gets overlooked is just the incredible, staggering scale of Chinese savings. I mean, just take a second to look at this number. China saves over 43% of its entire national income. That is an almost unbelievably high figure. I mean, it dwarfs most other major economies. And this isn't just some random statistic. It's the fundamental engine that's driving this entire global phenomenon. You see, there's this basic rule in economics. A country's trade balance is really just the difference between how much it saves and how much it invests at home. And because China saves so much more than it can actually invest productively within its own borders, that huge mountain of extra cash has to go somewhere. It flows out into the rest of the world, and that's what creates the massive trade surplus we always hear about.
So why do Chinese households save so much? Well, a lot of economists point to something called precautionary saving. Without a really comprehensive social safety net for things like retirement, healthcare, or education, families feel this intense need to build up their own huge financial cushion for the future. And that national habit ends up suppressing consumer spending and fueling that gigantic pool of savings.
So you put it all together. A managed currency, relatively weak demand at home, and this massive pile of savings. This combination has created this powerful new dynamic in the global economy, something that analysts have started calling China Shock 2.0.
So here's how that works. Because consumers inside China aren't spending enough to buy everything its super efficient factories produce, Chinese companies have to sell their goods overseas. And to win in a competitive global market, they often have to cut their prices. When this flood of low-priced goods hits the world, it forces prices down for everyone and really squeezes the profit margins of producers in other countries. That's what we mean by exporting deflation. Now check this out, because the contrast here tells the whole story. Look at key industries like cars, steel, and semiconductors. The volume of exports, the sheer amount of stuff they're shipping, is soaring. But look at what's happening at the exact same time. The price of those exports is falling, in some cases pretty sharply. This is exporting deflation in real time, and you can imagine the pressure this puts on competing industries all over the world. All these different threads, the managed currency, the trade friction, the domestic savings, they've all woven together to put China's leaders in a really, really tough spot. You could almost call it a stability trap, where they're being pulled by these powerful but completely opposite forces.
And this brings us to what feels like the most obvious question in all of this, right? If managing the currency creates so many headaches internationally and so many imbalances at home, why not, just stop? Why not let the market figure out what the yuan is worth, once and for all?
Well, this slide shows you exactly why that's so hard. This is the trap. On one side, you have that enormous trade surplus, which creates this massive upward pressure on the currency. Simple logic says the yuan should be getting stronger. But on the other side, you have all those trillions in household savings. The fear is that if you remove capital controls, a tidal wave of that money would rush out of China as people try to invest their savings abroad. And that could cause the currency to weaken. A lot, maybe even crash. So they're getting pushed in two opposite directions at the very same time.
And this brings us to the final and maybe most important takeaway. The whole argument over China's currency isn't really about the currency at all. It's a symptom of a much deeper structural challenge. The real solution isn't just about tweaking the daily fix or widening a trading band. It's about a fundamental rebalancing of the entire Chinese economy, shifting away from a model that's powered by massive industrial production and exports and toward one that's driven by its own people, by household consumption. And that leaves us with one last crucial question. How long can that rebalancing act be put off?